While Brexit headlines continue to make a splash across the media in the past several months, and as we'd expect going forward, we do encourage investors to keep a calm sensibility and focus on the fundamentals of UK assets. If we do expect a soft Brexit to occur, then we'd expect sterling to rise on a broad basis. This means that large cap UK stocks will underperform their mid and small cap peers. This is because with low sterling rates, large cap companies who get earnings from abroad translate them into UK sterling and are able to show higher earnings per share growth. So if we do get a soft Brexit, you'd expect mid and small cap to outperform. However, the key point is that if we do expect a global slowdown or recession at some point in the next few years, actually mid and small cap UK stocks tend to underperform in that period. So balancing these two scenarios, we'd actually lean towards saying taking a neutral view on UK equities is the way forward, not being overweight mid and small cap versus large cap, because there is quite a lot of uncertainty in the next several quarters. We've been doing a lot of work on thinking about which parts of the global equity market can weather the storm when there is a downturn in both the equity markets and the global economic activity. A few of those aspects would be having a lean towards value versus growth, because value stocks are now incredibly attractive versus growth stocks. There's also the ability for value, as we've seen in many S&P 500 downturns in history, to outperform growth in that time period. Another aspect of the equity market that reliably performs well in an S&P 500 downturn and a US recession are quality stocks. These are stocks that have solid financial assets, they are not overly leveraged, and they've got sustainable earnings profiles. So we suggest in the equity space, as we've discussed before, remaining regionally diversified, leaning towards value versus growth, and having an emphasis on quality stocks in a portfolio. With a fixed income point of view, being flexible about when to be over and underweight treasuries or gilts or any government bond is going to be crucial, because as interest rates rise at the end of the cycle, as we're seeing now, bonds in the government bond space are actually going to be challenged in terms of the returns they can achieve. However, when central banks start cutting rates in the midst of a recession, treasuries, gilts, and government bonds across the world are going to be the exact place that provide ballast in a portfolio. So being flexible on the fixed income side is crucial. Investors should be armed with a few key principles for long-term investing that they should always think about. So it doesn't matter exactly what year or what part of the cycle we're in, but having a focus on riding out the storm if the fundamentals are good, so maintaining a cool head when there's high volatility is a key factor. Being diversified, this is going to help in any scenario, whether it's diversified across regions or types of asset classes, and also having an eye on the long term. Some asset classes may be more volatile in the near term, but provide you a long-term return, which for a certain type of investor with a certain type of profile does make sense. So we have several principles we look at, diversification being one, keeping an eye on the fundamentals being another, and finally, maintaining a long-term view if your investment horizon is long-term is crucial at these times.